Hello everybody. Welcome to this full English amendment video for CA final direct taxes and international taxation applicable for Jan 26 settlements. Sir, how much amendments are there? How many? How to cover? Have we covered any of them? We have taken class. How much amendments we should be covering? Just try understanding this. Let me build premise for a minute. See, ICI has rolled out its booklet, which is of 72 pages. If you see number of pages, you can see 72 pages are written here. Okay. Of these 72, nearly 40 pages are those amendments that were part of September 25 only. So if you have taken any power batches or any of the regular batches which was applicable for September 25, you must have covered those amendments. That means majority of the amendments are covered by you. On 50% of the amendments are covered by you. But sir, there are certain amendments which are exclusively applicable for Jan 26. For that matter, I have prepared a PDF which speaks out all the amendments that are exclusively applicable for Jan 26 attempt. So if you have taken classes for September 25 attempt, you just have to do these Jan attempt amendments. But if you have done classes for May 25 and you have want to do both the amendments, this PDF includes amendments for September also. Got it, sir? We got your point. In this video, first of all, we will start with amendments applicable for Jan 26 exclusively. If everybody permits and time permits, then we will also cover amendments for September 25 also. Important amendments and sir, whatever the amendments were, we'll cover in crisp. Let's start without wasting a minute. First of all, you need to understand if your attempt is in Jan 26. Finance Act 2024 is only applicable. Finance Act 2025 is not applicable. Finance Act 2024 is only applicable for your attempt. And whatever amendments imply whatever the circulars, notifications, and judgments that have come up to 30th June 2025 are applicable for your attempt. Whatever judgments, whatever notifications, whatever circulars have come up to 30th June are only applicable. Okay, sir, got it. What all amendments? Just tell that. See, under capital gain, if you remember, we had section 54 EC. Under 54 EC, if anybody had capital gain, had long-term capital gain via selling any immovable property, they can claim exemption by buying bonds of 4 companies. If you remember, they can buy bonds of RECL, they can buy bonds of PFCL, IRFCL, and they can buy bonds of NHI. These 4 bonds were allowed to claim exemption up to 50 lakh rupees. But with effect from 1st April 2025, another bond is added to this list. Bonds of HUDCO, Housing Urban Development Company, I guess it is the correct name. HUDCO, bonds of HUDCO are also available for exemption under section 54 EC. But remember, this exemption is only applicable with effect from 1st April 2025. Is that clear to everybody? HUDCO is added to list of section 54 EC. Maximum investment allowed in a single year is 50 lakh rupees. If you invest in multiple years and claim exemption, then to 50 lakh maximum exemption is only allowed. So that's it. Very simple point. Not much to discuss. So minor amendment in assessment procedure. If you remember, return filing. If you remember, quoting of Aadhaar and PAN, sir, we were required to quote Aadhaar everywhere. Wherever we file return, we were required to quote Aadhaar. But we were also allowed to quote Aadhaar enrollment ID also. If we do not possess Aadhaar number, we can quote Aadhaar enrollment ID also. Sir, got it. Sir, this enrollment ID was stopped with effect from 1st October 2024. That means with effect from 1st October 2024, you were not allowed to quote enrollment ID. You have to mandatorily quote Aadhaar number. Got it, sir. We remember. But sir, what if you have already quoted Aadhaar enrollment ID? So government has given you a new date. New date, that is 31st December 2025. Try repeating after me. Listen. Try repeating after me. 31st December 2025 is the new date up to which you have to quote your Aadhaar number wherever you have quoted Aadhaar enrollment ID. See, you are allowed to quote enrollment ID. If you have quoted enrollment ID now, you have to quote Aadhaar at that place. Enrollment ID was valid up to a limit, but today you are not allowed to quote enrollment ID, and wherever you have already quoted in past years, you have to change it. You have to mention your Aadhaar number up to 31st December 2025. Got it, sir? Got it. This was the only amendment in assessment procedure. Sir, tedious thesis, what all amendments we have? See, exclusively for Jan 26, we have only a minor amendment. What it says? What happens is now sometimes we pay tedious TDS money. We have deducted TDS, now we have to pay to government. We have paid it. Money has been deducted from our account, but because of some technical glitches, it has not reached to government account. We paid, but it was not received by the government because of some technical glitches. What happens is, according to government, it is unpaid. According to us, we have paid. So government will charge interest on that. Right answer is yes, government will charge interest on that. Can we seek waiver for that interest? Right answer is yes. Earlier, waiver for that interest was not allowed, but we are allowed waiver of that interest. Where to seek waiver? Sir, you can go to CIT, PCIT, CCIT, and DGIT. You can go to these authorities. What is the threshold to which you can go to which authority? That has not been mentioned. Only thing mentioned here is you can go to CCIT, PDGIT, you can go to DGIT, you can go to these higher authorities for waiver. Got it, sir. But you can only go for waiver if there is technical glitches. If mistake or interest is on account of technical glitches, then only you can go to these authorities. Otherwise, you cannot go. Got it, sir. Got it. Got it. When can you go? As soon as order containing interest was passed. As soon as order containing interest is passed, let that year end, and within 1 year from end of the year, within 1 year from the end of the year of order, you can go to these officers and seek waiver. Sometimes you are forced to pay the interest. See, for example, I have paid the amount, but that has not reached to government. Interest started accumulating. We paid that interest. In good faith, we paid that interest. Later on, we want waiver of that interest. Can we get waiver? Right answer is yes, we can get waiver even if we have paid the interest, and we will be given refund of that interest. If interest was not supposed to be paid and we have paid it, out of good faith, we have paid it. Can we get refund? Right answer is yes, we will be given refund even if we have paid the interest amount. Are we clear, sir? Absolutely clear. If it is clear now, do comment down your experience, do like the video, and even if today you have not subscribed the channel now, you really don't want me to succeed now. You don't want me to succeed now. Mata Rani will not bless you. Mata Rani will not bless you. Do smash the subscribe button also. Okay. Sir, amendments in tax audit. Sir, there are minor, micro amendments in tax audit. A few of them only are important. See what happens is, there are two clauses, clause number 22 and clause number 26. Sir, we don't remember any of them. See, clause number 22 used to talk about what all payments you have to do to MSME enterprises. Whenever you make any payment to MSME enterprises, if it is outstanding, you were required to report under clause 22. Correct? Yes, sir. Clause 26 clause 26 required us to report about 43B. If you remember 43B, certain expenses are allowed on payment basis. If you are paying interest, it is allowed on payment basis. If you are paying bonus, if you are paying any kind of PF, ESIC, if you are paying any kind of gratuity, it is allowed on payment basis only. Correct? It is allowed on payment basis only. So every reporting of 43B was reported under clause 26. And 43 also includes 43H, that means payment to MSME. So MSME payments are reported at two places, clause number 22 and clause number 26. Same reporting was required to be done at two places. For that matter, government has given a relaxation that you don't have to report under clause 26. All the reportings of 43B are to be done under clause 26, but 43BH, that is MSME related payments, have to be done under clause number 20. I hope it clears up everything. Clause number 31, what it says? So 31, we don't remember 31. See, if you remember, 216 SS, 269 ST, 269T. You have taken loan in cash, you have repaid loan in cash, you have taken money of exceeding 2 lakh rupees in cash. In these cases, you were supposed to pay the penalties of 100%. These were the violations. If you remember, yes, sir, we do remember. If you do not remember, I have uploaded a marathon in which I have covered this topic in depth. Okay, if you have not watched, then do check out that video also. See, what I'm saying is, sir, if you have done any violation, earlier what used to happen was you just have to report, but now you have to report along with the code. If you have taken loan, then code A will be allotted. If you have repaid, code B will be allotted. Likewise, we have code from 1A to L. We have code from A to L. What code is for which payment? It is not specified. At least in your syllabus, it has not been specified. But for every kind of payment, code has been specified under clause 31. That is the amendment. And if you have taken loan from somebody and if you have repaid it to somebody, you have to report it separately. For example, I have a person called Abhijit. I have taken loan from Abhijit and I have repaid the same to the Abhijit. So I have to report it twice. Not in one entry I have to report it twice. Under different code, I have to report it separately. So more detailed reporting is to be done under clause 31. Got it, sir. Under clause 36b, what it requires us to report, see, if you have any kind of shares, if you have any shares and that shares have been bought back by any of the company. If you remember, under 2 clause 22 subclause F, it is considered as deemed dividend. Any money received on account of buyback is deemed dividend. So what you have to do is, sir, whenever you receive any sum on account of buyback, you have to mention the amount received. Second thing is the cost of acquisition of such shares. At what cost you have bought those shares, you have to report it. Did you get this point or not? So 36B only requires buyback related reporting. That's it. These were the basic ones. And the easy ones, the easy amendments. Now we have the Bahubali. Now we have the bigger amendment. For that matter, I want some patience. I want a little slowness to understand these provisions. Try understanding it with me. If you remember, there was a section 92CB, which talked about safe harbor rules. If you remember safe harbor rules. Safe harbor rules were the rules in which assessee can declare the transaction price up to a certain limit and government is not going to interfere. Whatever the transfer price, whatever the transaction price, whatever the profit that assessee is going to declare, government is not going to argue. On those transactions, reference to TPO would not be made. On those transactions, department is not going to do assessment. There were certain benefits given if assessee uses the safe harbor rules. But if you remember, no safe harbor rules were prescribed. But in September 25, government explicitly gave one safe harbor rule. If we had a foreign company and that foreign company is engaged in diamond mining, sale of diamond mining and sale of uncut, unassorted diamonds under special notified zones. Okay. If such foreign company is into the business of selling the uncut, unassorted diamonds in special notified zones of India, it can declare 4% of its profit, 4% of its turnover as PGBT. It can declare. This was a safe harbor rule given to such foreign company. This was the only safe harbor rule given for September 25 attempt. We'll discuss that if we said when we'll study amendments for September 25. But this was the only amendment available. Now, with due honor, I can proudly say government has given many safe harbor rules and you will enjoy every of them. Beautiful safe harbor rules government has given, and let us understand all of them one by one. Are you ready with me? If you are ready, then do comment down and do like the video, sir. First of all these safe harbor rules apply to international transactions. Sir, what are international transactions? Transaction where one of the parties is non-resident and both the parties are associated to each other. Okay, I am transacting. I am as a resident transacting with any of my non-resident associate persons. So all these transactions are relating to associate enterprises, that to internationally. Got it? First safe harbor rule given to a resident person. If any of the Indian person provides software development services to a foreign associate enterprise, software development services to a foreign associate enterprise. Now, what is software development services? Software development services like business application development or supporting of existing system, but does not include research and development. So, if as an Indian I am developing a software for my associate or providing backend support for the software development, I am providing these services to any of my associate, then it is software development services. Now, what safe harbor rule they have given? Provision says if value of our international transaction is up to 100 crore rupees. If whatever transaction we are doing with that associate enterprise is up to 100 rupees, whatever the transaction is of that transaction, 17% we have to declare profit. Government is not going to argue. 17% we have to declare and government is not going to argue. Did we get this point? Yes, sir, we got this point. But sir, if transaction exceeds 100 crore to 300 crore, then what to do? You have to declare 18%. You have to declare 18% as your profit. Got it, sir? What if transaction exceeds 300 crore? Provision says no safe harbor rule will be given to you. If transaction is up to 100 crore, 17%. If transaction exceeds 100 crore but up to 300 crore, then 18% of the transaction value you have to declare profit. And if transaction exceeds 300 crore, no safe harbor rules would be given to you. Did I make this point very clear? Yes, sir. Yes, sir, we understood. Similar safe harbor rules are given for IT enabled services. If any of the Indian entity provides IT-enabled services to its non-resident associate enterprises. IT-enabled services to non-resident associate enterprises. Sir, then whatever the transaction value is, if such transaction value is up to 100 crore, then whatever the transaction value is, declare 17% of it as your profit. Government is not going to argue. Similarly, if your transaction exceeds 100 crore but up to 300 crore, then whatever the transaction value is, declare 18% of that. And if transaction value exceeds 300 crore, no safe harbor rules given. Literally, no safe harbor rules given. No safe harbor rules given. Sir, we got your point. We got your point. We got the depth also. Now, only point here is, what is IT enabled services? You told us software development, sir. What is IT enabled services? You tell that also. See, IT enabled services na are back-end offices, back-end operations, whatever back-end operations that you manage. Call centers for if any foreign associate has call center in India. Okay. If any of the foreign associate has data processing center in India, if any foreign associate has insurance processing in India, Indian entity is providing that. If any of the foreign company has associate in India and Indian entity is providing payroll services, so these are IT enabled services based on information technology. These services are given, and if Indian entity bills, then it has to declare profit of 17 or 18% as per safe harbor rules. But here is the catch. So whenever we talk about IT-enabled services, IT-enabled services does not mean research and development. If Indian entity is provided research and development, then safe harbor rules would not be given. If Indian entity provides educational content development services, then the safe harbor rule would not be given. If any medical advice is given by this this entity, it is not relating to IT now, so no safe harbor rule would be given. If any clinical trial is being done, then this safe harbor rule benefit is not available. What are clinical trials? See, clinical trial is the stage when a medicine is being made and medicine is being tested in India. So these clinical trials are not IT enabled services. These are pure practices. These are not IT enabled services. So in that case, safe harbor rules are not available. So what did I just say? If it is software development services or if it is IT enabled services. If transaction value is up to 100 crore, then declare 17%. Transaction value exceeds 100 crore, up to 300 crore, declare 18%. If it exceeds 300 crore, sir, no safe harbor rule available. Are we clear? If it is clear now, sir, do like the button. Oh, sir, we have liked it twice. Like only one. Like only once. Like the video only once so that it motivates me. Okay, sir. If you are an associate, this is beautiful point. This is beautiful. This will open up the doors of your brain. This will open up your entire brains and this will make you think something. Understand this. If you are an Indian entity and you are providing KPO services. Yeah, you understand KPO, knowledge process outsourcing services. KPOs. You have already read BPO, KPO in childhood. Today you'll understand what actually KPO means. If you are an Indian entity and you are providing KPO services to a non-resident associate person. Okay, got it. Got it. And if transaction value is up to 300 crore, then safe harbor rule given. If transaction value is up to 300 crore, then safe harbor rule is given. If transaction value exceeds 300 crore, no safe harbor rule. Now, sir, what percentage to be declared? Is it again 17-18? Right answer is no. Here it is not 17-18. Here, percentage of profit depends upon employee cost to total cost ratio. Oh, sir. Oh, dear Lord. Oh, dear Lord. Why did you give this topic to us? Why January 26 attempt students are being pissed off with this topic? Hurry, don't worry. This is simple. This is very simple. When I was reading it for the first time, now, I too felt it technical. But only thing this requires is multiple reading. The more number of times you will see this video, the more number of times you will feel comfortable with this video. So what I want to say? If your transaction is up to 300 crore, then you have to check a ratio. What is that ratio? Employee cost to operating expense ratio. See, take the P&L. Of that, you have to take the employee cost and you have to take all the operating expenses. Employee cost to operating expense ratio. You have to find out. As soon as you will find out if this employee cost to operating expense ratio is exceeding 60%, that means majority of your expenditure is done on employee cost only. Now, so you have to declare 24% of the transaction price as your arm's length price or your profit. 24% of your transaction value should be your arm's length price if it is more than 60%. But sir, if this employee cost to operating cost ratio is between 40% and 60%, then in that case 21% to be declared. And if this employee cost to operating cost ratio is less than 40% now, then you have to declare 18% of your transaction price. 18, 21, and 24%. What do you have to see? If transaction value is up to 300 crore, then only you are allowed safe harbor rules. If it exceeds 300 crore, no safe harbor rules given. Second thing, you have to check employee cost to total operating expense ratio. If it exceeds 60%, take 24% as your profit. If it is between 40 to 60, take 21%. If it is less than 40, then take 18% as your profit. Got this point? Now, sir, important question is, what are KPOs? We understood what the two declare, but what are actual KPOs we did not get. See, KPOs are very simple. See, if any of the Indian entity is providing HR services, if any of the Indian entity is providing engineering services, these are, see, anything which is based on knowledge. KPOs imply anything that is based on knowledge. HR services, Indian entity is providing. Engineering services, Indian entity is providing. Design services, business analyst, market analyst, financial analyst. So these services, if Indian entity is providing now, then it is considered as KPOs. But sir, research and development are not considered as knowledge processing. It is separate altogether. We'll study that also. So are we clear? See, we understood 3 points. Try repeating after me. If Indian entity provides software development, 17, 18%. Transaction up to 100, 17, 100 to 300, then 18, more than 300, no safe harbor available. Indian entity provides IT-enabled services up to 100 crore transaction, 17%. 100 to 300, 18%. Greater than 300, no safe harbors. Sir, if Indian entity provides knowledge process outsourcing services, the transaction value up to 300, safe harbor allowed. More than 300, no safe harbor. Up to 300, what to do? Up to 300, what to do, sir? You have to check the ratio. Which ratio? Expect to operate employee cost to operating expense ratio. If it exceeds 60%, then declare 24%. If it is between 40 to 60, declare 21. If it is less than 40, declare 18%. Sir, did you get this point or not? Did you get this point or not? Did you get this point or not, sir? Fingers crossed, we are getting this point. So, fingers crossed, we are enjoying this topic. Now, fourth transaction in which safe harbor rules are allowed. Very beautiful transaction. If any of the entity provides corporate guarantee to subsidiary, here it is not just associate. Sir. It is a subsidiary only. This safe harbor rule is given for only subsidiaries, not for any normal associate. So if any Indian entity provides any corporate guarantee to subsidiary, then this entity should charge fees, of course. How much fees this entity should charge, this safe harbor rule will tell. This safe harbor rule will explicitly tell how much this Indian entity should charge as guarantee fees. And what the safe harbor rule says, see, if corporate guarantee amount given by this entity is up to 100 crore rupees, then in that case, 1% of the 1% should be charged as guarantee fees. Whatever the guarantee amount it is making, 1% should be charged, provided guarantee is up to 100 crore only now. If this Indian entity provides guarantee up to 100 crore, then 1% should be charged as fees. But sir, if it is charging more than 100, if it is giving guarantee for for more than 100 crore, will safe harbor be allowed? Will safe harbor rules be given to us? Right answer is normally no. Up to 100 crore, 1% fees to be charged. But if a guarantee amount exceeds 100 crore, then whether safe harbor allowed? Right answer is normally no. But sir, here is an exception. Beautiful exception. Try understanding this. Sir, if guarantee given to this a subsidiary, and the subsidiary is highest rated, that means AAA rated, beautifully rated, AAA plus, this subsidiary is highly rated. This subsidiary is highly rated. In that case, what would happen? In that case, you can still give guarantee and you have to charge 1% fees. You are given safe harbor rules. In that case, government is not going to argue. What did I just say? See, if guarantee amount is 100 crore, 1% to be charged for any SSC. But if guarantee amount exceeds 100 crore, then sir, normally safe harbor rules not given. But sir, if entity to which guarantee is being given is of highest credit rating, as per SEBI registered agency, then 1% fees can be charged and still safe harbor rules can be opted. So this is important. So what does corporate guarantee means? Corporate guarantee means explicitly giving guarantee for the loans taken by that subsidiary. It cannot imply a letter of comfort. If Indian entity gives letter of comfort, that does not imply corporate guarantee. If Indian entity gives implicit guarantee, it does not imply corporate guarantee. If Indian entity gives any performance guarantee, it shall still not imply it shall still not be corporate guarantee. Oh. This is the fourth safe harbor rule given. We have certain more beautiful safe harbor rules coming up. Sir, if any Indian entity provide research and development services to its associate, research and development services to its associate. Which research and development? Sir, software development related research or sir generic pharmaceutical medicine related research. So two kind of research and development services Indian entity can provide. What two? Software development related research, software development related research, generic pharmaceutical medicine related research. Two researches Indian entity can provide. What did I say? Just repeat after me. Software development services and sir, general pharmaceutical medicine research, two services that can provide. Sir, if transaction value between the Indian entity and this foreign associate is up to 300 crore, then they have to declare 24% of the international transaction as their profit has safe harbor rules. If transaction exceeds 300 crore, no option for safe harbor rule available. What did I just say? Indian entity providing research and development. Research and development for two things. It can be either software development, it can be either generic pharmaceutical medicines. It can be for either of things. If transaction between Indian and foreign associate is up to 300 crore, then Indian entity has to declare 24% as their profit. If it exceeds 300 crore, then no safe harbor rule is allowed to them. Remember, for every case, till now, whatever we have studied, now for every case, 300 crore is given, but for corporate guarantee, it was 100 crore. Okay. Sir, moving further, another simple case. Don't worry, we'll revise this to the fullest. You need not to worry about it at all. Your amendments are in very safe hands. Okay. If Indian entity manufactures and exports auto components, if Indian entity manufactures and exports auto components to an associate, Now, sir, if Indian entity manufactures and exports core auto components, core auto components imply, sir, core auto component imply mean engine parts, transmission, suspension part, braking, steering, lithium ion batteries. These are core auto component parts. If Indian entity manufactures and exports core auto components to its associate, then profit margin shall be 12%. But sir, if Indian entity manufactures and exports non-core auto components, that means screwdrivers, small brakes, small things, in that case, sir, 8.5% shall be the profit margin. See, because of course, core auto component part will have higher margin and non-core will have lower margin. So it is reasonable. Higher 12% and 8.5%. Sir, are we clear with that? Arey Baba, batao na, are we clear with that, sir? If Indian entity manufactures and exports, if core auto component parts is being manufactured and exported to associate, then 12% should be charged. 12% should be charged as a profit. And if it is exporting non-core constant core auto parts, then in that case, 8.5% should be charged. We got that point? Yes, sir, we got that point. Now comes the most beautiful of all. And you will enjoy this. And there are greater chances that you might see question from this topic only. If Indian entity give loans or advances to any of the associate in its group, if Indian entity give loans or advances to any of the associate in the group, it should charge interest. Of course, it should charge interest. How much interest it should charge, that is given by safe harbor rules. Provision says if this Indian entity is charging minimum this interest, now whatever is given, government is not going to argue at all. But if it is charging lesser than that, then again it has to face the assessing officer, it has to face the TPO, it has to face the assessment. Everything will be covered. But sir, this if Indian entity charges this much of interest as per safe harbor rules, then in that case no argument will be made. So how much interest shall be charged is being asked in this point. How much interest this entity should be charging is the main subject matter. Sir, first of all, point to be noted is whether this Indian entity has given loan in rupees or in foreign currency. Whether the loan is rupee denominated loan or whether this loan is foreign currency denominated loan. That has to be first of all checked. If loan is being denominated in rupees, then how much interest this entity should be charging? Sir, remember, try repeating after me. SBI rate plus something. SBI rate plus something. SBI rate plus something. Sir, SBI rate plus something. If this loan is in foreign currency. For example, this loan is being given in dollar. If this loan is being given in dollar, then foreign currency rate plus something, foreign currency lending rate plus something. Remember, SBI rate plus something, and foreign, if loan is in dollar rupees, SBI rate plus something. If loan is in foreign currency rate plus something. Are we clear? Are we clear? If loan is in dollar, then you have to take the US interbank rate. If loan has been given in Singapore currency, Singapore interbank rate. If loan has been given to London interbank rate, LIBOR we have to take. If loan has been given in Malaysia, Malaysian dollar interbank rate, that has to be taken. So I will tell you everything. But are we clear that if loan is in rupees, then the SBI rate plus something. If loan is in foreign currency, then in that case, foreign currency lending rate plus something has to be charged. Are we clear? Yes, sir. We are clear. If loan is given in foreign currency, remember, try understanding. If loan is given in foreign currency, then foreign currency lending rate plus something, foreign currency lending rate plus something. Sir, here we have to check 30th September 6-month foreign currency rate. You have seen the 6 months LIBOR rate. That 6 months LIBOR rate in transfer pricing we used to check now for secondary adjustment. 6 months LIBOR rate we have to charge if transaction is in foreign currency. 6 months LIBOR rate we charge. Similarly, 6 months secured financing rate of the foreign currency as on 30th September of the previous year. So for example, if you are charging interest for previous year 24-25, then as on 30th September, whatever the lending rate as is on the 30th September of that currency, that will be charged plus something. And what is that something? I will be telling you. What is that something? I will be telling you. Are we clear? Are we clear? Are we clear? Rupee loan. So SBI lending rate as on 1st April plus something. Foreign currency lending rate, foreign currency loan. Then in that case, foreign currency lending rate plus something. Okay, sir, got it. Now, what something is important? What something is important? Try understanding this. Try understanding this. What something depends upon to which entity you are lending. See, that lending rate is fixed. Lending rate is fixed. SBI rate is fixed for everybody. But something extra depends upon the credit worthiness. For example, if this Indian entity is giving loan to somebody who is already a defaulter, so higher rate should be charged now. If this loan is given to somebody who is very safe, so lower interest should be charged. So it depends upon the credit rating of this foreign entity. And what credit rating says, if any of the entity which is AAA rated, AA rated, single A rated, then foreign currency lending rate plus 1.5% is to be charged. If this foreign entity is triple B rated, then 3% to be added. If this foreign entity is B rated, double B rated, single B rated, then 4.5%. If this is very poorly rated C category entity, D category entity, then in that case 6% to be added. Whatever the lending rate of that foreign currency is, plus 1.5% for A, 3% for triple B, 4.5% for B, and 6% for C and D. Simple. Can we take one example? For example, Rahul gives loan to Rachel. Rachel is in USA. And Rachel's credit rating as per CRISIL, as per ICRA, as per any of the registered credit agency is, for example, C rated. She is C rated. And USA's lending rate is, for example, 5%. So 5% plus C rated 6%. I have to charge minimum 11% from Rachel. This is what this point implies. I have to charge minimum 7% from this Rachel. Okay, sir, we got that point. Sir, are we clear with this credit rate point? Foreign currency lending rate, foreign currency lending rate, foreign currency lending rate, foreign currency lending rate plus 1.5, 3, 4.5 and 6. Sir, 1.5 and just 2 or 3 or 4 times you just have to calculate. You will get the point. Are we clear with that point? Yes, sir, we are clear. Similarly, if loan is given in rupees, then what to be added? So SBI lending rate, whatever rate at which SBI lends, that has to be taken plus something may 1.5% for AAA, 3% for triple B, 4.5% for B, double B and single B, and 6% for C. Add 0.25%. This will give us 1.75 for AAA, 3.25 for BBB, 4.75 for B, and 6.25 for C and D. If C. See, simple point it is. Very simple point it is. What I am saying is, if loan is in rupees and loan is in foreign currency. If loan is in foreign currency, then what to do? If loan is in foreign currency, then what to do? Foreign currency lending rate plus 1.5 plus 3 plus 4.5 plus 6. But if a loan is in rupee, then it's SBI rate plus whatever the rate has been 1.5, 3, 4.5, and 6. Add 0.25% to it, and you will get 1.75. You will get 3.25. You will get 4.75. You will get 6. You will get 6.25. Whatever rate that you have understood, now just add 0.25%, and that will be SBI plus the following. Oof. Shall we go a further step ahead? Shall we go? Shall we go? If you all agree, we can go a step ahead. Yes, sir. Yes, sir. You can go. If lending, if you are lending to somebody and that to less than 250 crore, if this Indian entity is lending to any of the foreign associate, and that to total lending is up to 250 crore rupees, and that to foreign currency lending is being made, in that case, in that case, in that case, sir, one foreign currency lending rate has to be taken 1.5%, 3%, 4.5%, 6%. All these rates are available depending upon credit rating. See, 4.5 and 6 is not to be considered. Maximum 4% is to be charged if credit rating is B to C. And that is what completes your interest portion. This is what completes your interest portion. How much interest to be charged? Let me take you through this point again. Let me take you through this point again. If Indian entity lends money to any of the foreign associate, if lending is done in foreign currency, then whatever the foreign currency lending rate is, take that and add something. What something to be added? Try understanding this. If loan is exceeding 250 crore now, then credit rating has to be taken. If AAA credit rating 1.5%, if triple B credit rating, in that case 3%, if B or double B, then 4.5%, if C and D, then 6% is to be added. But if lending is only up to 250 now, then sir, 4.5 and 6% is not to be added. You can have to maximum add 4%. Maximum 4%. 1.5, 3 and 4. Maximum that is allowed. Okay, sir, got it. But sir, if for lending is being made in rupees, then in that case SBI lending rate plus something, whatever credit rating we understood, 1.5, 3, 4.5 and 6, add 0.25% to it, and you will get the required figures. Sir, got that point. What all measures are being made? What all things are to be added, sir? If Indian entity has provided low value adding services, what low value adding services imply? See, if the activities which are not relevant for business, which do not require any tangible intangible assets to be used for providing such services, and that value is up to 10 crore now, then no transfer pricing provision would be applied. Low value adding services does not mean in research and development, does not include any IT services, ITES, BPO, KPO, sales, marketing, insurance. These services are not low value adding services. Are we clear? Certain points to be considered while understanding the safe harbor rule. Certain points to be considered. First of all, whenever SSC wants to opt for safe harbor rules, it has to file a form called 3 CEFA, CEFA, Form 3 CEFA, before the due date of ROI. Whatever the due date of ROI is under section 139(1), before that due date, SSC has to file Form 3 CEFA. Points are clear, sir. Very clear. SSC has an option to either opt for safe harbor rules for 1 year or for a block of 3 years. That means for previous 25, 26, if he's opting, or 24, 25 is opting. So 25, 24, 25 he can opt, 25, 26, 26 he can also opt, and 26, 27 also he can opt. He can opt for 3 years. He has a choice either to opt for every year individually, file a form every year, or he can opt for 3 consecutive years. But important point is, in whichever year he is filing the form, he has to file it before the due date of 139(1). Got it, sir? Whenever he files the form, whenever he chooses to opt for safe harbor rules, there is an officer, assessing officer, who will check that whether SSC is eligible and transaction is eligible. See, if I am not providing any software development services and still offering 17% only, so assessing officer will object now. So assessing officer has to check that whether I am eligible and transaction is eligible. Perfect. If AO doesn't understand anything, if AO is angutha chap, if AO doesn't understand anything, what he will do, he will refer the case to TPO. Within how much time he should refer? Sir, he should refer the case within 2 months from the end of the month. As AO checks out, he has to refer the case to TPO within 2 months from the end of the month he receives the order. What TPO will do? TPO will check whether the transaction is eligible or whether assessee is eligible. If TPO finds out that assessee is not eligible, if TPO finds out the transaction is not eligible, if TPO has asked us any document and we have not furnished document, in either of the cases, TPO will declare our safe harbor rules as invalid. Whatever TPO does, whatever TPO wants to do, so TPO has to pass the order within 2 months from the end of the month in which assessing officer has referred the case to TPO. 2 months time limit is constant in the safe harbor rules. 2 month time limit is constant. So what did I just say? TPO can declare the safe harbor rules as invalid. So the best part of this topic is if TPO fails to provide any order within 2 months, if TPO fails to provide any order within 2 months, then what will happen? What will happen? Whether safe harbor rules will be invalid? Right answer is safe harbor rules will be valid. If TPO has failed to provide any of the judgment in 2 months, safe harbor rules will be invalid. For example, whatever judgment that TPO would be making, whatever the output TPO would be making, he has to give reasonable opportunity of being heard to the assessee. Got it, sir? For example, TPO says that safe harbor rules are not allowed. I am an invalid assessee. I cannot claim safe harbor rules. Do I have any option? Do I have any option to go somewhere? Yes, I can go to commissioner, not CIT, not joint commissioner appeals. This is commissioner CIT. I have to go CIT. I don't have to go CIT appeals. I cannot go to CIT appeals here. It is just commissioner I can go to. Within 15 days of the order, I have to go, and commissioner has to check whether TPO has done correct or not within 2 months. Commissioner has to pass an order whether TPO has done correct or not. Commissioner can either reject the order of TPO, can invalidate the order of TPO, can confirm the order of TPO, but he has to do within 2 months. If either of them did not pass order within 2 months, if either the assessing officer cannot pass order in 2 months, if TPO cannot find out in 2 months, if a commissioner cannot pass order in 2 months, in all the cases, safe harbor rules are valid. Remember, in transfer pricing, we had a provision for 3%, 1%. See, if transaction price is not the arm's length price. Sometimes what happens is transaction price and arm's length price are not the same. But in that case, what we had 3% cushion, and in wholesale trading we had 1% cushion. We can increase 1%, 3%, but this 1%, 3% margin is not available in safe harbor rules, sir. Whenever you go for safe harbor rules, sir, you have to maintain documents under section 92D. You have to get your books of accounts audited under section 92E, sir. 3CEB has to be furnished. Once you opt for safe harbor rules, remember, sir, mutual agreement procedure option is not available to you. You want to sit with that other country and discuss what tax consequences would be. Right answer is you are not allowed. You are not allowed to go for MAP. Remember, sir, best part of this provision is if you are having any associate in an entity which is either notified jurisdictional area or which is low tax paying country, in that case, safe harbor rules are not allowed. What did I just try understanding this? For example, if Rahul is located in India and some other person is located in Cyprus, or for example, Bermuda is a notified jurisdictional area, and for the time being, Bermuda is a notified jurisdictional area. I cannot opt for safe harbor rules if I am charging fees from somebody who is located in Bermuda. If I am transacting with any entity who is located in NJA, I cannot opt for safe harbor rule for that transaction. Here. Another point to be added, if I am transacting with a foreign entity which is of that country where tax rate is very low, that means tax rate is less than 15%, I can still not opt for safe harbor rules. For example, if my associate is in Dubai, and I am providing software development services to the associate in Dubai, can I opt for 17-18%? Right answer is no, because Dubai has no tax rate. Zero corporate tax rate. If any of the foreign tax havens, if you are transacting with any of the foreign tax havens, then in that case, safe harbor rules are not allowed to you. I hope you got the point. Clear? This was all about your safe harbor rules. Let me take you through this topic again. Let me revise you again what these safe harbor rules imply. Indian entity providing software development services, transaction up to 100 crore, 17%, 100 to 300 crore, 18%. Indian entity providing IT enabled services, transaction up to 100 crore, 17%, exceeding 100 crore, up to 300 crore, at charge 18%. Over 300 crore, no safe harbor available. If Indian entity providing KPO services and transaction up to 300 crore, SHR available, over and above, no, not available. How much to be declared? You have to check employee cost divided by the operating expense. If it exceeds 60%, 24% to be charged. If it is between 40 to 60, add 21% to be offered. If it is less than 40, you have to add 18%. If Indian entity provides corporate guarantee to any of the subsidiary which is an associate, what to do? If corporate guarantee is 100 crore, then 1% fees should be charged. If corporate guarantee exceeds 100 crore, then sir, normally safe harbor rules are not available. But if that subsidiary is of highest standards, highest credit rating, then 1% fees has to be charged. If Indian entity provides research and development services for any of the associate relating to software development or relating to generic pharmaceutical medicines, in that case 24% has to be offered. Remember, but transaction value has to be up to 300 crore. If it exceeds 300 crore, no safe harbor rules allowed. If Indian entity manufactures and exports core auto components, then 12% to be given. If it manufactures and exports non-core auto components, then 8% to be added. If Indian entity provides loan to any of the associate, in that case, if loan is in foreign currency, then whatever the foreign currency lending rate is as on 30th September of the previous year, add something to it. What is that something? So if that foreign currency is of AAA rated, AA rated, single rated, add 1.5%. If it is triple B rated, then add 3%. If it is double B rated, then 4.5%. If it is COD rated, then add 6% to it. But if loan given is up to 250 crore now, then for B category, double B category, C category, D category, maximum interest that you have to charge is something plus 4%. That foreign currency lending rate plus 4% you have to charge. But if loan is given in rupees, then you have to charge the SBI lending rate plus something. Whatever A, B, C, D we have studied there, whatever A, B, C, D rates we have studied there, add 0.25% to that. At last, we understood if we are providing any non-value adding services or low value adding services up to 10 crore, then no transfer pricing rule shall apply. Safe harbor rules given to you in that case. These were the amendments applicable for Jan 26. For those who have taken classes very earlier and who have not done amendments for September 25, see, there might be many people who might have taken classes in December only, and they are preparing from very back end. So you must have not completed the classes, or you have taken old classes. So for that matter, you have to cover September 25 amendments also. And what are applicable amendments for September 25? Let me take you through. See, first of all, under TDS chapter, there were 5 or 6 transactions on which no TDS was applicable. What were those transactions? For example, in India, we have IFSC. In India, we have IFSC. If any of the person makes any interest payment, commission payment, many services payment on which TDS is applicable, provision says you don't have to deduct TDS of any IFSC unit. Why TDS? Why not TDS? Arey Baba, when this IFSC unit is not liable to pay any tax, it is opting 80 LA now. If this IFSC unit is not paying any taxes, it is opting 80 LA, then why TDS would be deducted? So no TDS if any of the IFSC unit is opting 80 LA. Got it. Next important point, what it says, if any of the non-resident has a savings account in offshore banking unit of IFSC. IFSC can have offshore banking unit? Yes, sir. If any non-resident has a savings account in this case, or any of the account, so in this case, whenever interest is being paid, no TDS on this interest. No TDS on this interest has to be deducted by this offshore banking unit of IFSC. Sir, got it. Third amendment. If you remember section 194N, if you used to withdraw from bank, if 1 crore withdrawal was there during the financial year, no TDS. But if withdrawal was exceeding 1 crore, then whatever the amount exceeds it 1 crore, government was required to TDS on that. If whatever amount exceeded 1 crore, then 2% TDS was deducted. But there were certain exceptions. If you remember, if government withdrew more than 1 crore, no TDS was applicable. If bank withdrew more than 1 crore, no TDS was applicable. Cash replenishment agencies, the white label ATM operators, when they used to withdraw, no TDS was applicable. In that list only, 2 more entities are added. As per the guidance, as per the recommendations by the foreign ministry, sir, 2 more entities, sir, for UN bodies and foreign consulates. See, UN bodies, many of the UN bodies are in India. If they withdraw money for their expenses, no TDS under section 194N would be applicable. Then, if you remember section 196, what was section 196, sir? There are certain entities for which no TDS provisions are applicable. For example, government. If you make payment to government, no TDS is required to be deducted. If you make payment to mutual fund, no TDS is required to be deducted. If you make payment to LIC, no TDS is required to be deducted. Similarly, in that list, one more item is added, one more entity is added. So, Credit Guarantee Trust Fund. Credit Guarantee Trust Fund, if you make payment to this Credit Guarantee Trust Fund, no TDS would be applicable. Another important point, sir, if you are making sales to any unit located in IFSC, if Rahul is selling any goods to person located in IFSC, if I am selling goods worth rupees 100 or 10 crore, so remember, there is a provision of TCS under section 206C1H. Whenever I am selling goods exceeding 50 lakh rupees to person located in IFSC, I have to collect a TCS na 1%, 0.1%. So this provision is also not applicable if I am selling goods to person located in IFSC, because he is opting at TLN. He would not be paying any taxes. So no TCS. So there was also amendment. If you remember, there was section 206 C1F. Whenever any of the person sells motor car to somebody who is not into motor car business. Okay. So I am required to collect a TCS at the rate of 1%. I am required to collect TCS at the rate of 1%. If I am selling motor vehicle exceeding 10 lakh rupees, I have to collect TCS at the rate of 1%. This was the provision. In that list only, sir, there were certain items added. Now, if you are selling shoes exceeding 10 lakh rupees, single pair of shoes, not multiple shoes, single pair of shoes, if you are selling for 10 lakh rupees or more, see, Virat Kohli sells his shoes for more than 10 lakh. MS Dhoni sold his shoes. Ronaldo sold his shoes for more than 10 lakh rupees. So if they are selling shoes exceeding 10 lakh rupees, they have to collect 1% TCS. If anybody is selling wristwatches, if you are buying Rolex wristwatch, then 1% TCS would be collected. If you are selling any of the art pieces, antiques, paintings, then 1% TCS to be collected. Sunglasses, handbags, purses, coins, stamps, collectible items, sportswear, sports equipments, horses which are used for horse racing, and so yachts, rowing boats, and helicopters. If you are selling any of the luxury items, then 1% TCS is to be collected. Sir, we got your point. Another important amendment, sir, in case of non-resident taxation. If you remember, new section was introduced for your attempt, section 44 BBC. In case non-resident cruise shipping company had an option, not an option, has to mandatorily offer 20% of their shipping income as PGBP. Presumptive taxation was given 44 BBC. But sir, what is a cruise shipping company? That was not defined. But in September 25, it was defined. If any of the ship which has a capacity of more than 200 passenger, more than equal to 200 passenger, and that ship covers more than 2 Indian ports, and that ship is not for cargo, it is for leisure. That means it should be for time pass. Sir, in that case, it is a qualifying ship and it has to offer 20% income. Also, sir, many of the foreign companies used to have a time pass office, license office in India. No transaction, but just a license office in India. Now, these license offices were not held accountable in any cases. But sir, provision said if these license offices does any kind of financial transaction, or even if they don't do any transaction, now they have to submit a statement of financial transaction. Whatever financial transaction they have done, they have to submit a statement in form 49C. To when for previous year 24-25, they have to submit it within 8 months from the end of the financial year. That means up to 30th November, they have to submit the details of whatever transactions they have done. In transfer pricing for September 25, what amendments were there? See, there were two major amendments. First of all, safe harbor rules relating to that foreign diamond company was available. Sir, what was the amendment? Let me tell you. If any of the foreign company is into diamond mining, sells raw diamonds. Foreign company which is into diamond mining sells the raw diamonds. Raw diamonds means uncut, unassorted, unpolished diamonds. Then whatever the money received for sale of diamonds in special notified zones, or money receivable for sale of diamonds in India in special notified zones, it has to offer 4% as PGBP. 4% of PGBP. See, remember, PGBP is 4%. Even in safe harbor rules, income is 17-18%, 24%. Income rate is 7 this much. Tax rate would still be 35%. In this case, foreign company 35%, for domestic company, if it is offering 17-18, tax rate might be 25-30. That is different thing. But sir, these are not tax rates. These are income rates. This is the amount of income that has to be declared. So a foreign company is into diamond business, uncut raw diamond business, and selling diamonds in special notified zones, then 4% is to be offered. Sir, what conditions? Again, other expenses will not be allowed to you. WTV shall remain. Sir, no losses shall be set off against this 4% income. Documentation to be maintained. Audit will be done. Sir, no issue. 3 CEFC has to be furnished. Sir, before the ROI, if AO feels that incorrect information has been submitted, then no safe harbor rules allowed. No mutual agreement procedure would be allowed. Sir, we got that point. These are very basic things. Also, there was another important amendment. If any of the entity is into IFSC, and these entity, if any of the companies into finance company located in IFSC, and if this entity pays any interest to any of the associate located outside India, will 30% limit applicable? If you remember 94B talks about maximum interest that you can pay to an associate. Maximum interest that you can pay to an associate is 30% of EBITDA. But sir, these provisions are not applicable to finance company located in IFSC. If any of the finance company in IFSC is located now, for them 30% provisions are not applicable. Sir, there were certain amendments relating to compounding of offenses. This is an important amendment. If somebody who has not understood compounding, I have uploaded entire video on compounding. Here I will be referring things in a faster manner. What does compounding means? See, for compounding means zamanat. We call it zamanat. See, if you are already in jail, you can come out of the jail by paying certain fees to the government. Compounding was also already done, was already happening in income tax, but with effect from 17 October 2024, new set of guidelines came. And what were the special cases of these special points of these guidelines we have to discuss? First of all, as of now, every offense in income tax is compoundable. Even if you have if you have done any of the willful default, you are assessing default, if you have been sentenced to imprison, then you can get the compounding done. You just have to pay the fees, you will be compounded. You just have to pay the fees. Sir, what happens? Sometimes prosecution is not even initiated. No prosecution is initiated. You can still pay the compounding fees and you can reprieve yourself from any of the future imprisonment. You can reprieve yourself. If no proceedings have been, you have done certain mistake, you know that you have done certain mistakes, you can pay the compounding charges and you can save yourself from imprisonment. You can do it in advance. Sir, clear? Whenever compounding is being done, you have to pay three kinds of fees. Three kind of fees you have to pay. First of all, you have to pay the application fees. Whenever you are applying for compounding, application fees you have to pay. Second thing, you have to pay the taxes. Whatever taxes you have missed out, you have to pay that. Third thing you have to pay is compounding fees. That zamanat fees, that fees you have to pay to the government, that you are seeking relaxation instead of jail. You are seeking relaxation. So three fees have to be paid. Sir, while application, what happens? Try understanding this. Whenever you are applying, see, for example, compounding happens for different sections. For example, if you have done any prosecution, if you are being prosecution under section 276B or the 276BB or the 275, any of the section, if you are being prosecuted, you are seeking compounding. So for every section, you have to see compounding separately. But sir, you have an option to file a consolidated statement also. If you will seek application for single offense, for single section, you can see compounding. If you are seeking compounding for single offenses, now you have to pay 25,000 rupees application fees for per section. For per section, you have to pay 25,000 rupees. But if you file consolidated application, now you have to pay 50,000 rupees fees as entire application. Got it, sir? We got that point. Sometimes what happens is, sir, these new guidelines came on 17/10/2024. It might be possible now that we have already filed application for compounding under old provisions. It might be possible that we have filed for compounding under old provisions. Yes, sir. If under old provisions we have received a compounding, no issue whatsoever. That compounding shall still continue under new guidelines. If under old provisions our compounding was rejected, in old provisions our compounding was rejected, then what can be done? We can still file for compounding again in new provisions, and that will be under consolidated application only. Okay, sir. But sir, what if we have filed for compounding and we have not still received the compounding under new guidelines? Then you don't have to do anything. That old application will be assumed to be new application only. You don't have to file new application for those section which is still pending. So if already received, ignore. If rejected, then apply under consolidated form, consolidated application. If pending, then ignore, because that old application will be considered as new application. Sir, got it. Sir, to whom you can apply compounding, sir? CCIT, PCIT, PCCIT, PDGIT. Okay. They will refer the case to assistant director, deputy director. They will ask SSC to pay the compounding charges. They will ask SSC to pay the taxes. Sir, SSC has to pay the compounding charges within the end of the month, within 1 month from the end of the month of intimation. As soon as assessing officer asks SSC, within 1 month, SSC has to pay the compounding charges. SSC can get the extension because compounding charges can be heavy. So SSC can get extension. It can get extension maximum up to 24 months. For 6 months, they can get extension from any of the authority. If they want extension from 6 months to 12 months, they can go to CCIT. If they want extension from 12 months to 24 months, they have to go to CBDT chairperson. For more than 24 months, they are not allowed extension. If they fail to pay compounding charges, then in that case, sir, prosecution application shall be rejected. Now, how compounding charges are calculated? See, normally compounding charges are fixed. Compounding charges are fixed. For example, I have done offense under section 275. How much question will be give you? Question will give you, for example, 50,000 is the compounding charges. 50,000 is the compounding charges. How much you have to pay? 50,000. Now, once you submitted application under 275. Now, if you are being convicted for same offense in next year, for example, 275, again for next year, you are being prosecuted. You have committed offense under section 275, you have submitted application, you have paid compounding fees. Next year, again you committed offense under section 275. Now, in this case, compounding fees, whatever is, you have to pay 1.2 times. Oh, oh, wow. Wow, wow, wow. Now, if you have paid whatever the amount you have to pay, for example, 60,000 you have to pay, you paid. Now, again for next year, you have committed offense under section 275. Then whatever the compounding charges are now, 50,000 rupees, you have to pay 1.4 times. That means 70,000 you have to pay. Again, if you are being prosecuted for same section in next year, then in that case 1.6 times. So your compounding charges will increase every year. Every year your compounding charges would increase. Remember, remember. Sir, if you have filed an application, under old guidelines, and that is being rejected in old guidelines, and you are now requesting compounding again under new guidelines, under consolidated application, then this will be considered as second application under the same section, and whatever the compounding charges for this rejected application would be 1.2 times only. Would be 1.2 times only. There is a question in RTP that you must refer. RTP September 25 MCQ. You can refer that. I have also a video on that RTP. You can refer that video also. That will give you clear insight as to what is to be done. Sir, if you are co-accused, for example, if you and your brother have commonly done a crime, then in that case you can either go separate, you can either have single application also. Remember, compounding can be sought even if no prosecution has been initiated. This entire PDF has been circulated by me in my Telegram channel. This is the summary of the compounding. If you want to refer, you can refer with noble cause. Thank you so much, guys, for this wonderful support. I hope you enjoyed this session. I hope this session was value adding for you, and I hope with this session you are able to score good marks. If this session added value to you, then do share it with your friends. Do share it with the ones who may need this amendment video, because for sure in this attempt amendments are going to be tested, and not just Jan-26 attempt, but certain amendments from September 25 will also be tested, and certain amendments from May-25 will be also tested. For May-25, I have already uploaded entire video. You can also refer that. That is also good video. You can also refer that. So if anything you feel like must be covered in English, do let me know in the comment section. I have uploaded entire marathon and international taxation for September 25. That is valid for you also. You can also and that another marathon I will be taking for Jan-26. That will be different. That will be more energetic. I will be taking superintendent marathon in English also. I will be taking small topic marathon in English also. If you think any other thing to be done in English, do let me know. Do like the video so that I am motivated, and I am more what should I say, incentivized to come up with more such videos. Thank you guys. Bye bye. Take care and enjoy studying. See you guys in another session.